In the last few years, investors have warmed up to the idea of including low-cost, large-cap index funds in their portfolio. The Nifty 50, the Nifty Next 50, and the Nifty 100 are three indices that people invest in and often make assumptions which might not always be true. In fact, a popular misbelief is that the Nifty 100 is a summation of the Nifty 50 and the Next 50 indices. So in this video, we shall address any such confusions that investors might have as we understand these three large cap indices in greater details. Let's begin. The Nifty 100 index is a basket of India's 100 largest companies. The selection of these 100 companies is rather straightforward. We extract a directory of all companies that are listed on the National Stock Exchange. We sort this list per their total market capitalization, and the top 100 companies from this list forms the Nifty 100. Once we have our 100 companies, the next step is to assign a weight to each of these companies. One can think of a weight as a sort of an importance that is given to that company within the Nifty 100 index, which is done on the basis of the company's free float market capitalization. So do make a note of this. While the selection of the 100 companies is done on the basis of the total market capitalization, the weights that are assigned to every company in the Nifty 100 index is done on the basis of its free float capitalization. Let's understand this with an example. So here's a list of the 5 largest companies by total market capitalization: Reliance Industries, TCS, HDFC Bank, Infosys, and Hindustan Unilever. As expected, all these companies are a part of the Nifty 100, and what we now want to do is to define their weight in the Nifty 100 index. We start this process by penning down the investable weight factor or the free float factor for each of these companies. The free float is defined as that portion of a company's shares that can be readily subscribed and traded by the general public and are not controlled or held by promoters, the government, or any strategic institutional investor. So where it says that Reliance Industries has a free float factor of 0.49, it means that 49% of the shares in the company are held by non-promoters and are readily tradable. Now notice here that TCS and Hindustan Unilever has much lower free float as compared to an HDFC Bank or Infosys. So when we multiply the free float factor with the total market cap, the resulting free float market cap of a TCS comes out to be much lower than an HDFC or Infosys. In fact, other companies like HDFC Limited and ICICI Bank that did not make it to the top 5 companies per the total market cap method are very much a part of the top 5 as per the free float market cap method. Okay, now that we have the free float market cap of all 100 companies, we simply do a summation of this number, which comes to somewhere around 90 lakh crores, and compute the weights for each of the 100 companies on the basis of this. So Reliance Industries gets the highest weight of 9.1%, then HDFC Bank at 7.8%, and this keeps on decreasing as we go down the list until we reach the 100th stock. So simply put, higher the free float market capitalization, higher is the company's weight in the Nifty 100. Now let's pan our attention to the Nifty 50. The Nifty 50, or Nifty as it's commonly called, is India's leading stock market index. It represents the weighted average of India's 50 largest companies that are listed on the National Stock Exchange. Now we have a detailed video on the Nifty 50 on this channel, so we won't repeat parts of that. But if you haven't watched that video, then please do so. I'm sure you'll find it very useful. Alright, so the stocks that comprise the Nifty 50 index are simply the top 50 stocks from the Nifty 100 index. Of course, since the Nifty 50 is a shorter list, the weights assigned to those companies are higher than what we see in the Nifty 100. In fact, from a free float capitalization basis, if we try to fit the Nifty 50 inside the larger Nifty 100 box, the Nifty 50 would take up about 86% of the space, with just 14% available to the next 50 companies, which together form the Nifty Next 50 index. Now, as the name suggests, the Nifty Next 50 index includes companies which are ranked from 51st until 100 within the Nifty 100 list of companies. In other words, companies in the Nifty 100 minus companies in the Nifty 50 gives us the Nifty Next 50 index. These 50 stocks in the Next 50 index are often seen as future Nifty 50 candidates, which makes this index a very attractive proposition to many investors. In fact, over the last 18 years, more than 40 stocks have been upgraded from the Nifty Next 50 index to the Nifty 50 index. Now, one distinct aspect of the Next 50 index when compared to the Nifty 50 and the Nifty 100 is the relatively even distribution of individual stocks. So while the top 5 stocks in the Nifty 50 and Nifty 100 contribute up to 41% and 35% of the index respectively, the Nifty Next 50's top 5 stocks weigh in only 18% of the index, making it the least concentrated large cap index amongst all 3 options. Yet another polarity we can see here between these 3 indices is their sectorial participation. Now, the Nifty 50 and Nifty 100 have rather similar sector representation, with about 75% of the allocation going to just 4 sectors: financial services, IT, consumer goods, and the energy sector. In that context, the Next 50 index is where a lot more diversity is available, with participation in a lot more sectors, with no sector taking up more than 20% of the allocation per the current numbers. As expected of any equity product, all 3 indices go through periods of ups and downs. But having said this, the Nifty Next 50 index seems to have a little more ups and a little more downs. In the up cycles, that is in 2007, 2009, 2012, 2014 and in 2018, the Next 50 index did a lot better than the Nifty 50 and the Nifty 100 index. But as everything that goes up also comes down, the years 2008, 2011, 2015, 2018 and 2019 were the time periods when the Next 50 index was relatively off the pace. When we look at returns over longer periods, the Nifty Next 50 has the upper hand with annualized returns of 14.6% over the last 15 years. However, as we established earlier, there have been bumps and bruises along the way, which is reflective in the 3-year annualized returns for this index. But perhaps a more practical way of looking at this data would be to examine it on a monthly SIP basis. And for this, we got our researchers to put together data on how a 5-year SIP, a 10-year SIP, and even a 15-year SIP would have delivered in terms of performance. Now, just as we saw with lump sum returns, the SIP returns too have a pattern where the Nifty 50 and Nifty 100 have had some strong momentum over the last 5 years, but over longer periods, it's the Next 50 SIP that has delivered better returns. Perhaps the biggest misunderstanding related to these 3 large cap indices is that the Nifty 100 is a perfect combination of the Nifty 50 and the Nifty Next 50 index. What I mean is, many investors feel that instead of investing in 2 indices, they can simply invest in the Nifty 100 index. But from what we have seen earlier in this video, it's not as simple as it looks. Let's take a scenario where we invest 10,000 rupees in a Nifty 50 index and another 10,000 rupees in a Nifty Next 50 index fund. Now remember, your objective here is to have a properly weighted portfolio of India's top 100 companies. So the first 10,000 rupees gets sort of apportioned according to the weight of each company in the Nifty 50 index, which means 1,080 rupees goes to Reliance Industries, HDFC Bank gets 931 rupees, and so on. And this sequence continues until the 50th company, Shree Cement, that gets allocated 35 rupees in line with its 0.35% weight in the Nifty 50 index. Now let's look at the other 10,000 rupees that we invested in a Nifty Next 50 index fund. In this case, the company with the highest weight is Avenue Supermarts. So 5.08% of 10,000 comes to 508 rupees, and that's where the complexity is. You see, Shree Cement is the 50th ranked company, which effectively gets 35 rupees of the overall 20,000 rupees that we have invested. On the other hand, the 51st ranked company, Avenue Supermarts, is being apportioned a much higher 508 rupees. In fact, if we jumble the Nifty 50 and Next 50 indices, we can clearly see which company is apportioned how much of our invested money. It is this deception that many investors don't realize, and hopefully this video has explained that. But now the question is, what can you do? You like the Nifty 50, you like the Next 50, these are established indices, multiple schemes, expense ratios have been going down, so you still want these in your portfolio, but you also want a systemic allocation of companies in line with the Nifty 100. One way to go about this is to use the information we shared earlier, that is the Nifty 50 comprises of 86% of the Nifty 100 and the Next 50 has 14%. This means if you were to allocate the entire 20,000 rupees in an 86-14 ratio between the Nifty 50 index and the Nifty Next 50 index, then you will get a more Nifty 100 aligned distribution. So to put it all together, each of the three large cap indices we have discussed today have a different composition of holdings, returns and risk structure. The Nifty 50 and Nifty 100 look and operate like first cousins, but have not delivered as well as the Next 50 index. Likewise, the Next 50 is more cyclical in its movement, which means one might have to look at this index more from a long-term view. So is there a single winner? No, we don't think there is a single winner, but having said this, it is our opinion that a combination of Nifty 50 and Nifty Next 50, which can be aligned in a ratio per your risk profile and market conditions, does have some serious merits in it. For instance, if you're long-term oriented and don't mind a little volatility, then you can look at a 25% allocation in the Nifty 50 with 75% going to the Next 50. In fact, to help out, here's a table on how different allocations of the Nifty 50 and the Next 50 would have worked for you over the last many years. So do see what works best for you, and if you have any questions, then feel free to post it in the comments box below. And with this, we come to the end of this video. If you like this presentation, then do tap on to that like button and don't forget to share this video with your friends and family members who are just getting started with investing. We wish you the best and look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.